be be aware. Monetary supply expanded by over $1 trillion, right? I'm gonna show you here 550 trillion to 650 trillion, 6.5 trillion. Not 650 trillion, sorry about that. But 605 trillion in less than 1 month, and nobody is talking about it. Well, how the hell did it happen? Well, let's find out. So this part is underreported. Nobody's talking about the Federal Reserve has increased its the M1 supply in the United States has increased from 5.5 trillion to 6.5 trillion essentially. And it's not reported. The only article I found was some German article that talks about the M1 exploding, and nobody cares and nobody talks about it. And they published this on the 8th of December, so 10 days ago. So somebody was following the M1 supply, and they were like, "What the hell is going on with the M1?" And they're like, possibly, it's. I was also thinking, what could happen with M1? Why is it going up? Well, the first thing I thought was like, okay, the Fed is doing QE. And I go and I look at the Federal Reserve's balance sheet of total assets, and it hasn't increased. And I'm like, whoa, that's weird. I mean, the first increase, like from in March till July, right? That's this March till July, right? That's explainable. But what's this increase in December? Like, it's not like they don't have the data. Their data goes until the December 16th. I'm like, okay, what else is there? Well, what about cash deposits, like bank accounts and stuff, right? Banknotes, because that's also mentioned in the article. And I look at banknotes, I'm like, holy crap. What the hell? Why is there like such a huge increase in demand deposits? And I look at the increase and I'm like, whoa, that's let's see, let's zoom in on this. We're going to go from 2 trillion to 3 trillion. I'm like, huh, what? This is where this $1 trillion came out? What's happening? Like, why is it happening like this? And I've been looking a bit into the stock market. Like, I've been building, basically I've been building a machine learning program. I built it for gold, and now I'm building it for the stock market. And I'm trying to track the S&P 500 and see like if I can predict how it's going to evolve. One of the things that that showed up is that the long-term prediction for the market is positive, extremely bullish. But historically the S&P 500 has been bullish overall. But what about like what if I look at shorter terms? Like if I look at to see if there's like negative pressure on the short terms. Okay, I don't have anything on the 7-day, 14-day, still more or less positive, but you can see that like it's not hugely positive. It's not like gaining 2 or 3% every single day. It's really like sub 1%, gains most likely. So then I decide to look, maybe what about the 21-day midterm negatives all over the board. 3-day short term, extremely short term negatives. What I also found was that this predictor, actually, I used the same method to build this prediction for the S&P 500 ETF as I did for gold, and actually it works better for the stock market than for gold pricing. But to cut it short, it's pretty accurate. Like from the test results, it seems to get it right, the direction right, at least 52% of the time. And the accuracy of the stock within range, it's within a 90 plus range. It's like 99%, 98% accuracy. So it's pretty good. It gets it more than like, it's not wrong a lot of times, but it does see like a lot of negative pressure in the short midterm for the S&P 500. And they got me thinking, right? When was the last time we saw something like this, like a jump like that? And I was thinking maybe if we look back, we could find something. We could see a jump like that. And I was like, huh, we did see a jump like that. And that was in 2000 and let's see. Look at this. We did see a jump like that. We saw a jump like that during the Great Recession. Cash deposits went up. And I'm thinking, what the hell? Why did they go up? And I'm thinking like, what happened in 2008? What was a product that crashed the markets in 2008? It was synthetic products, basically bundled up products held in by third parties, right? The banks would buy these securities that were bundles, and these bundles were held by basically their assets and traded by other companies. And if these bundles and those companies that were issuing these assets, these securities, went down, then the banks could never get their money back. What is the bundle, the largest bundle right now in the US stock market, right? And I was thinking, okay, what's the largest bundle? Well, it's ETFs. And if I look at ETFs, I'm like, okay, ETFs is a $5 trillion market. Is it possible that over the last few days, there's a large amount of ETF, people pulling money out of ETFs? It's not so easy to pull a large amount of money out of ETFs. We've seen some. Earlier this month was Vanguard ETF pull out 7 billion, where somebody sold $7 billion of Vanguard's ETF. So I'm thinking that there's some pullout from ETFs, and some people, smart money, is actually trying to get their money out before some of these funds start going bust. Because if you are an ETF fund and you go bust, you can't get your money out. The middleman who does the selling of the fund, you can't get you won't be able to redeem if they go bust. You can't get your money out. It's locked inside it's lost inside Vanguard. If Vanguard goes bust, then you've got a real problem. If you put your money with Vanguard. What does that mean? That is a very good question. Do I think that there's going to be another crash? I honestly, I don't know. I don't know if there's going to be another crash. Obviously, if I look at the Great Depression, right? Great Depression is 1920. We don't have data from back then, but during past, let's say, past recessions where there were problems, in, let's say, the 2000s, in 2001, we also saw a decrease in demand deposits. That's interesting. Okay, so it's actually, there is a consistent pattern. Anytime we are before a recession, we see a huge spike. Could this be another spike before a crash in demand deposits, like a spike in demand deposits preceding a crash that happened in 2008? We had the exact case. 2000 dot-com crisis, people sold off. 1987, let's see if it happened in 1987. 1987, same thing, right before the crash. Massive demand deposit increases. Yeah. I mean, be careful. That's all I have to say. I don't know what's happening. I just thought that people need to know what's going on, that there is potential extreme movement coming up in the market. You can't have M1 increase by $1 trillion, which is roughly 20%, without having any consequences to the overall economy. It just doesn't happen. Did M1 increase by that much in 2010? This would be interesting. Oh, it did. Wait, 2009? Oh, it did. Yep. Boom. Yep, it did. 2000. Ooh, yep. We see another spike. The recession spike. Yeah. I'm not sure what to make of it. It does look like it's not a. It could be just that, it could just be nothing. Could be that people are looking to buy into the market, but honestly, like last time something like this happened, and the balance sheet changed during that time, or was it just monetary? Let's see, 2008. 2008. No, balance sheet didn't really change. There's no significant move. Well, this is the money printing, October. Huh. Wait a second. Let's superimpose this. 2008. So when did this spike happen? M1 money shock. Stock 2008. We see it increase slightly. Assets demand 2008. Let's see, 2008. Yep. Let's see, what date is this? 29th of December. 29th of December, total assets. October, November, March, April, May, June, July 2019. So, no, this was correlated. The Federal Reserve played a role in creating this. What about 2000? Let's see if 2000 is somewhat similar. Don't have balance sheet in 2000. That's not helpful. That's not helpful at all. Yeah, I don't know what to make of it, but it does seem that anytime we have a spike in demand deposits, there usually is. Let's see if it spikes more. If it does one jump and it does another higher jump, potentially we might see a market correction. But this is not a good sign. Like, I can't tell you that when I see this, having it's a great sign and everything's gonna be hunky dory, because previously it's never been a good sign when you have such a huge shock to your huge shock and growth in the demand deposits, especially over such a short term. It's not common. It's not common, and typically it's involved with some sort of sell off. Could be the bond sell off. Countries are dumping bonds, but if looking at how things are going, it feels like some people are pulling out of ETFs. That would be my theory. Don't trade on it. I'm not a financial advisor. I don't have inside information. I don't have any information. It's just that, like, I saw this article, and I saw some stuff the machine learning program was outputting for the S&P 500, and I'll put a link to the predictor anyway, so you can see what it's predicting and what it believes will happen to the stock market. But don't trade on it. It's not financial advice. It's not accurate. You cannot just don't. I'm not a financial advisor. Use your own judgment. Do your own research. Ask your financial advisor what you should do. Don't ask me. I'm not a professional in the field. Anyways, be aware that money supply has increased by a lot, by almost 20% in after there was a 40% increase, another 20% increase, and then but assets balance sheet hasn't changed. At the same time, the Federal Reserve's wait a second, Federal Reserve's balance sheet in 2000. Wait a second. No, the balance sheet has not changed at all, and but every time we've had such a spike, it was not a good sign. It was the last time we had such a spike was 2008. In 2000, we had less money, so it looks like there's only a blip, but actually it was a spike. And in the 1990s, 1987. So be careful. It's strange times we live in. That's all I have to say. And thank you for watching. Hope this gets around so people are more aware and you're a little bit more careful. And I don't know if a crash is coming, but anyways, it's possible. At this point, anything's possible, and you have to just wait and see what's happening. I personally don't feel comfortable going into the stock market at these levels. That's my personal choice. Don't follow me. Don't necessarily trade on what I do. But I think in the long term, like overall, the economy is obviously positive, as long as you know, debt finally can be under control. People are out spending. Overall, the economy can recover, but I don't know if these levels are healthy, like the valuations for the S&P 500 with such high debt levels. Anyways, that's my opinion. Don't believe everything I say. Don't trade on anything I say. And thank you very much for watching. Hope you have a great day. I wasn't planning on making a video tonight, but after I saw the news, after I ran some of the predictions and I saw what was coming out of it, I thought like maybe probably should do a video. Thank you very much for watching. Click the like and subscribe button so you can stay up to date on anything I find, and on breaking news. It's not really breaking news. On breaking news, and hope you stay safe. Keep stacking, stack safe. I've got some more gold and silver coming in. I'll show you guys what I picked up. Should be here. I should get it all by the end of next week, so before Christmas. Thank you very much for watching. Dave out.